Okay, this is question number 9, and I'm going to go through the adjustments. Okay, first adjustment, they said that general expenses were accrued, were unpaid, and loan interest was accrued. Okay, this information is broken up into two different adjustments. So for the first one, general expenses were unpaid. It means that I haven't paid $625. Okay, I should go up here, adjust for 625, increase. Okay, this is adjustment number 1. Okay, and at the same time, I will have a accrued general. So this is for additional information number 1. Okay, and loan interest was accrued. Okay, how do we calculate out the loan interest? Okay, look at my interest expense. My interest rate is 5%. Okay, this is the interest rate. So 5% multiplied by my principal amount, $7,500, I get $375. Okay, loan interest is an expense, but loan repayable, this is a liability. Okay, it's two different things. This is a liability, this is a expense. Okay, so because the loan interest was accrued, we will adjust for interest expense. Okay, this is additional information number 1 as well. Okay, and we also have a accrued interest. Okay, so two adjustments. Okay, the next one, insurance relate to a 15-month period. Okay, the insurance in this case, okay, let's see, my insurance amount is $450. Okay, this amount, 450, was paid for 15 months, ending on 31st August. Okay, let's see our year end. My year end is on 31st May. Okay, 31st May. Okay, therefore, from 31st May to 31st August, okay, we don't count May because it's already over, right? So we count June, July, August. It's actually 3 months. Okay, what is this implying is that they are paying insurance in advance for 3 months, okay, after my financial year end. Okay, I repeat again, my financial year ends on 31st May. But they are paying all the way until August. Okay, this means that they are prepaying it for 3 months. And how do I calculate my prepaid insurance? I'll take 450 divided by 15 because they paid for 15 months times 3. Okay, I prepay for 3 months, $90. Okay, and because I'm paying in advance for the next financial year, I have to subtract. Okay, this is additional information number 2. And I also have a prepaid insurance. Okay, the third one, a review of the trade receivables showed that $500 was unlikely to be collectible. Okay, the word unlikely to be collectible tells us that the ending balance, okay, this is actually my ending balance for allowance. Okay, therefore, I know that my ending balance has to be $500. Okay, but the business has only recorded $300 so far. Okay, but question tells us that the ending balance, I want it to be 500. Okay, so we have to increase my allowance by 200. Okay, and this increase in allowance would result in a impairment loss on trade receivables. This is actually an expense. Okay, and this is my additional information number 3 here. Okay, so my allowance will go up by 200 to 500, and my impairment loss is 200. This is the loss incurred in that year itself, from 300 to 500. Okay, so this is the loss incurred. Okay, depreciation is to be depreciated at 10% per annum using the straight line method. Okay, I'm not going to go through this because this is the same as the previous question. Okay, my depreciation amount, this is equipment is 2800. Okay, I will increase my accumulated depreciation by 2800. My equipment, my motor vehicles is 5760. Okay, and I will also increase my accumulated depreciation by 5760. Okay, please come and see me if you are still unsure on how to calculate depreciation. Okay, no record had been made on inventory taken for his own use. So this is drawings. Okay, my drawings will actually go up by 350. And my inventory will go down. Where's my inventory? Inventory, yes, go down by 350. Okay, this is additional information number 5. Okay, the next one, a gain on sale had been recorded in the sales account. Okay, the word sales is also synonymous with sales revenue. So they have wrongly recorded down this $195 in the sales revenue account. Okay, this is wrongly recorded. So what do? We will take out or subtract, okay, 195 from my sales revenue. Okay, because they wrongly recorded down inside here. Okay, so I will subtract 195. Okay, remember that the other adjustment would be we have to create another account called gain on sale of non-current asset. Okay, this would be my additional information number 6. And gain on sale of non-current asset, this is actually under my other income in my income statement. Okay, so later when we're doing our income statement, we will see the word add other income, gain on sale of non-current asset. Okay, last one, repayment of the entire 5% loan will be in June 2020. Okay, June 2020 is actually 1 year from the date of the balance sheet. Okay, my balance sheet date is 31st May. So 1 year from this date, which is 31st May 2018, okay, any amounts to be paid back after 31st May 2018 okay, is called long-term borrowings. Okay, why 2018? It's because 2018 is 1 year from 31st May 2017. Okay, so what do? Is that usually we will see where is the balance sheet date. It's 31st May 2017. 1 year forward, 31st May 2018. Okay, and any amounts that I have to pay back after this 1 year is called long-term borrowings. Any amounts that I pay back between 31st May 2017 to 31st May 2018, this will be called current portion of long-term borrowings. Okay, so later this entire amount, I will have to reclassify it as long-term borrowings in my balance sheet.